Hello friends, welcome to Skill Club. Friends, last time we had talked about basics of ESOPs, employee stock option plans. Friends, we had been getting a lot of queries around how to value startups, and so we thought why not to create a content around it, and so we are bringing this video for you. So friends, any company has two class of owners. One is debt owners and another is equity owners. So it is clear that value of any company is value of debt plus value of equity. But most of the internet companies, e-commerce companies, startups that you see, you would notice that they have almost no debt or very negligible debt. So for these companies, the value of their business is nothing but value of their equity. So how to value, what is the valuation method for these companies? So international valuation standard tells us that there are three approaches for valuation of any business. That is cost approach, income approach and market approach. So cost approach is also called balance sheet approach or net asset value method. Income approach involves DCF method, which is discounted cash flow, and market approach is comparable transaction method. So let us see what are these things. So we know, friends, that basic accounting equation is asset is equal to equity plus liability. So in balance sheet method, we find out what is the fair value of the assets, what is the fair value of the liability, and we deduct asset minus liability and we get the equity. So what do we mean by fair value? Because see, let's say a company is having land and building in its balance sheet and it was purchased 5 years ago. So it was purchased for, let's say, $100,000. So in balance sheet, it will be carried at historical cost, and today, because of for 4 years of depreciation, the value of the land and building in balance sheet might be less than $100,000. It might be whatever, $80,000 or $85,000. But in real life, if there is a more commercial development around the area, the value of the land and building might be 2 or 3 times. So it is clear that balance sheet values do not always carry the fair value, latest value of the assets. So that is why we are using the term fair value of the asset and fair value of the liability. So balance sheet method does not mean that you just take the values from the balance sheet and do simple arithmetic and that is your value. Okay, so now income method. Income method involves certain terms. One is discount rate. So what is discount rate? Discount rate is the rate of the return that investors expect. So friends, we know that basic concept of finance is more risk, more return. So any investor who is investing in a startup is definitely taking a risk because as per the industry statistics, around 1 in 1,000 startups meet their projections. So that is, around success rate of 0.1%. So if investors are taking that kind of risk, they will definitely require higher return. So let's say investor expects a return of 25%. So the discount rate will be 25%. And what is FCF? FCF is free cash flow. So businesses require cash. They require cash to be able to pay their employees, to be able to pay their vendors for the material they have bought, for the services they have used, and to be able to pay taxes to the government. So how this cash flow is calculated? This is calculated from the revenue and the cost and the capital investment that the company is going to make. So from balance sheet and P&L of the company, we calculate the free cash flow for each year and we apply the DCF method. So these things, friends, are very detailed topics in itself, and valuation is a very vast subject. So whenever we shall prepare a separate content around DCF method, we shall discuss these things in detail. Now, what is comparable transaction method? So let's say we have a target company X, and then we have to find out what are the companies similar to company X where investors have made some investments. So let's say we find out these companies are A, B, C, D, E. Now these companies definitely cannot be exactly similar to X, but they have to be similar to X. In similarity means similarity in size, in the same kind of business model, same kind of risk, serving the same kind of geography. So I mean, it has to be similar. So and then we find out the key metric for these similar companies, and this metric could be enterprise value by sales or enterprise value by operating income. So enterprise value is nothing but the value of the firm that we discussed here, which is value of debt plus value of equity. So any company which does not have any debt, so their enterprise value is the value of the equity. So we find out some key metrics of that business, and based on that metric, we find out the valuation of the target company. So friends, it is not easy to apply any of these methods in case of startups. Why? Because startups do not have much assets in its balance sheet. Most of their assets are intangible assets. So not easy to use balance sheet method. Similarly, startups do not have a history. So it is very difficult to make future income projections. Sometimes, sometimes these projections could appear like a guesswork, which it is not. So income method is not very easy to apply. And then we have comparable transaction. So as we discussed, it is very difficult to find a comparable company where investors have made some investments. So if those companies are not similar, it is not easy to apply market method. So what do we do? How do we value startup companies? So friends, angel investors and venture capitalists around the world who have been mentoring and investing in the startups, they have prepared some kind of a rule of thumb and some kind of models to value these startups, mostly pre-revenue companies, and also for the companies which have started earning revenue and which are growing. So these are some of these methods, and in the next video we shall discuss some of these methods and how to value any startup based on these methods. So see you in the next video, friends.